You're listening to a Mint podcast brought to you by HT Smartcast.
How does an investment portfolio that is supposed to last for several generations look like? Well, in today's episode of Why Not Mint Money, we are in conversation with Ashutosh Bishnoi, who is the director at Multi-Ag, on how does a cockroach portfolio look like and what are the things to keep in mind when building such a portfolio.
Welcome to Why Not Mint Money, a personal finance podcast where we help you understand basic money concepts and share strategies for you to build your wealth. So let's get started with your money journey.
Hi Ashutosh, welcome to the latest episode of Why Not Mint Money. It's really great to have you here. So Ashutosh, we wanted to chat with you about this investment approach that you guys have called cockroach portfolio. So can you tell us more about your approach towards investing and how you look at investing for family offices, ultra HNIs and HNIs, and what is this cockroach portfolio that you guys talk about?
Yeah, thanks, Josh. Effectively, what we do at Multi-Ag is create strategies for large pools of multi-generational capital to be invested. The capital may be owned by business families, or it could be owned by individuals who've done well. And today, a lot of people from the tech world have made serious amounts of money. What we look at is when you have a large pool of multi-generational wealth, we believe that the principal focus of investment must be preservation of wealth for the next 100 years, let's say. And in order to do that, it must behave like a cockroach, which means it must be indestructible. The cockroach is the longest surviving animal on the face of the planet. It survived everything, the Holocaust, the dinosaurs, and everything, right? Because it adapts very quickly to the new realities of its environment. And that's the nature of a portfolio that one needs to build. Why it needs to be that way is because, large pool or large corpus owners seldom behave in the manner of wanting a very high alpha on their portfolio. The maximum return that business families get from their money is from their business, right? So, and whatever capital can't be absorbed in the business, then it needs to be managed. And it must be managed so that it's available when the business needs it, or it's available when the next generations need it. Mostly well-doing business families or high net worth individuals don't need any current cash flows from their investments, which if they do, then that part gets invested for cash flows. So the principal focus is survive, and survive in good shape. Survive and be alive. If you just wanted the money to survive, you could put all the cash inside a steel box and, bury it. But the idea is that you must not lose its purchase value, its buying value. Should do better than, inflation in whichever market you are in. Reasonably better than that. In fact, it should grow nicely without taking such risks that will cause permanent dent in the portfolio. When we started to think like that, we, over a period of time, evolved into a portfolio. We call it the cockroach portfolio or the all seasons portfolio. And the way it ideally works in a global market is that we put 25% each of the portfolio over a period of time in 4 different asset classes. One is high quality equities. Second is high quality fixed income securities. Third is real assets, which means, it could be real estate, it could be commodities. And fourth is highest quality of cash. Now, when you start to look at these alternatives for allocation, in each market across the world, there are different choices you have to make. Not everybody offers you exactly the same asset quality or type. For example, in India, it's very difficult to buy into commodities. You can invest in commodity futures, but taking a long position in commodities is very difficult. You can't do that in other parts of the world. In real assets, for example, I've worked alongside firms who used to manage lumber land, timber land.
Right.
That's a really long asset class. is even longer than farmland. Farmland, produces something every year. But timber gets produced only when, the tree is tall. It's like 30, 40, 50 years. So those asset classes are not available as asset classes in India. So people tend to do it themselves, which is also fair, but suffers from other challenges of liquidity and disposability and valuation.
Yeah.
So you build to the best of your ability towards this 25% each goal. Typically in India, it ends up being more like, almost 50% in equities and the remaining split between fixed income and some real assets and some. What we do for cash is currently we believe that the highest quality of cash available in the world is gold.
Yep.
Or, the three metals, palladium, gold, etc. Then the bullion. Because we believe that bullion is the longest used currency in the world, and it continues to enjoy the status. Although fewer people use it as real currency, but when it comes to tough times, they turn to it. So in a sense, it's also like your portfolio insurance. When you speak about high quality equities, we speak about equities that will, over a period of time, the business underlying those equities will create free cash flows of large orders so that they're not dependent on capital markets for their survival. Now, having said which, it sounds like a very small set of equities, but when you start looking around the world, the choices are many. So when we start building a portfolio, this is the approach we take.
But how do you, why these particular asset classes? What's the correlation in terms of how are they correlated to each other? I mean, does it really help in the sense of diversification?
Sure. When you build an uncorrelated portfolio is when you build preservation. You don't look for counter correlation because that's a risk, right? People used to say that, debt and equity were counter cyclical, but, there have been many bouts of time in the last 25 years in the world markets and Indian markets where debt and equity have in tandem performed, in the same direction. So you then don't look for counter cyclical, you look for uncorrelated. So I'll give you an example. When we are building a family portfolio, we, in the last 5 years, have begun to move away from public markets. We believe that the world public markets, which is financial securities, are so financialized that even a small ripple of some kind, a small event could cause a huge wave of volatility. I mean, you saw, for example, what happened 2 days ago with Japan, right?
Yeah.
It's a country making a small move in rate change, and it sort of brought down a significant percentage of many parts of the world markets, right? That happens when the leverage is high, when the financialization is high. So we decided about 5-7 years ago that families should move away from this public market exposure to private market. Now, private market has their challenges. Some of it comes with private equity, some of it comes with private debt, and there could be other structures possible in between, right? But the challenge with that is the world has not created standardized way of looking at private markets. Yes, there is a huge private market industry, and some lessons you learn. You look at liquidity, you look at exits, you look at cash flows, you look at how to do a good deal. Those tenets are in place, so you can make a sound deal for your family. But comparability, availability of information on an ongoing basis, it is something that you have to work at. When you invest in a private equity deal, and you may not be the largest investor, your ability to influence the deal, influence the reporting and the information, the rights, it all changes, right? And as the company grows bigger, because now there are more startups looking at private equity than running businesses looking for private equity, right? So you do get challenges which are not similar to the challenges of the public market. Public markets, you get all the information you want, you can analyze it to the last final detail, and you know exactly where you are, what risk you have, what information you can get, what is the return, what's the likely return. You can build models. You can't do that in private markets. But what you do get in private markets is exactly the lack of financialization, which means you don't get extreme valuations. You do competitively sometimes. There are people trying to build unicorns, and there are still cases which will continue to be of companies which will demand a very high value, though have no profitability, but valuation is high. But the trick is to find out the ones which will ultimately generate cash flows of large order.
Right.
Private credit is a very interesting space. India is only discovering it now. We've been investing private credit globally for a while now. And you get some very, very interesting opportunities there, because these are usually well-run businesses which are private. And for the reason that they don't want to either go get entangled with banks or with capital markets, want to raise credit privately. And you get some fantastic opportunities in private credit when you start looking for them.
Right.
In India itself, for example, there is a large number of businesses who fall below the radar of the banks.
Yeah.
Right? Typically, and some of them don't want to go to the bank because it will require a lot of effort of a different type. You have to get into ratings, you have to get into documentation of a different type, which banks will look at, because banks have to follow norms, right, from RBI.
Yeah.
They look at, they may have short-term need for money. They may need bridge financing. They may need a specific project financing, which you as a private business house, because ultimately, families are business houses.
Yeah.
You have an appreciation for what this might be better than maybe a credit evaluator,
Sure.
right? And then there are these softer issues. I mean, you may give credit to some people you run business with.
Yeah.
Right? There's a relationship there, and your ability to recover is very quick. So you take the newer considerations come into place, and it offers pretty good opportunities. I mean, in some cases in India, you get almost equity-like return from private credit. Of course, it does come with a risk, but if you take the risk, you find a way to mitigate the risk. Those can be very good options. So I'm saying, when you look at building our seasons portfolio, it's not just about building out a public market global portfolio. There's private in it, there's real assets in it. I mean, for a while, almost for 10 years, the real estate market in India or elsewhere in the world was in the dumps, right?
Right.
It was a great time to start building a real estate portfolio at the time, and families can do that, because see, guess what? Families hope to remain as multi-generational families, hope to pass on this money to the third and the fourth generation. That's like 70 years away. And which asset class better than real estate to serve them?
Sure.
Right? So you are able to make those decisions in building that portfolio, which purely in public markets is very difficult.
And Ashutosh, that's great, but this idea of cockroach portfolio is quite interesting. What if a small investor wants to may not be able to exactly probably mimic the portfolio as you guys talk about cockroach portfolio, but if he wants some kind of semblance of this kind of a portfolio which he can serve him or her for a long period, how can he or she go about it? Yeah.
It can be done, Josh. It's not that, it's nothing to do with size. It has to do with two things. One is, you must get your goal clear. If the goal is preservation first, it doesn't matter the size, right?
Yeah.
I find a lot of people alluding to small investors as being rash and greedy. Now, you may not be a greedy, rash small investor, right? You may just want to do the right thing by a portfolio, so it's around when you need it. And if that is the case, you can build a 25 portfolio in India, as with as little as 2 or 3 lakhs of rupees, right? You can go buy you can buy a good mutual fund for 50,000 rupees, right? You can start an SIP at 10,000 and or 5,000 and keep building it up. And there are good funds there. I mean, many of our clients, we actually bring them to these funds.
Right.
With some very well managed funds.
Because now the categories have exploded a lot than what they were, say, a few years back.
Absolutely.
Even commodities.
You can do that in equities. Take a really high quality flexi cap or a multi cap fund. Then you can also take a little bit of the gold ETF. or the sovereign gold bond, right?
Right.
You can buy REITs.
Sure.
Yeah. And you can buy commodity futures.
Right.
So you can build this. And it doesn't take a lot of money.
Right.
Just that you must not then expect that every now and then, every year, you will get 30-40% return. That's not going to happen.
Sure.
There are times that equity will give you that. Last year it did, right?
Right.
A portfolio of 25 would have given you a 40% return because equity brought in 80%, right?
Right.
So it can happen, but let that not be the benchmark.
Right.
A portfolio of this size, of this nature in India, if you get 12-13% on an annual basis, on a sustainable basis, that's a great return to look for.
Right.
And if you remember, the really long-term equity return in India is 13%.
Yeah.
That's what Nifty has given you over the last 40 years.
Right.
Yeah.
Right.
So if you're going to get it out of an all-season portfolio, you are great. And
Yeah.
Your portfolio, your capital is intact.
Right.
Problem is that you let your ideas run away with saying, "Oh no," then something called the FOMO effect.
Yeah.
So that gets better of you, then you lose a strategy.
Right. So for small guys, first and foremost, it's important to know what your goals are. Are you trying to preserve? Are you trying to grow that capital? And then go about
Sure.
your investment strategy.
Yeah. And these things change with life stage, isn't it?
Yeah.
When you start out, you may say, I look at preservation.
Right.
But then, 5 years, 7 years down the line, you're doing well. You're able to take more risk. You may shift your goal strategy and you don't want this. Maybe you leave this portfolio as such and build another one, which is more aggressive.
Right.
That's what families do.
Right.
They don't touch an original portfolio. They don't change.
Right.
That part of the portfolio which is doing fine, that's a capital preservation portfolio. Leave it.
Okay.
It survive 50-70 years.
Sure.
Let me build another one separately if I want to take aggressive risks somewhere.
You don't sort of
Undo
or kind of unnecessarily tweak the strategy of the portfolio.
Which is not a strategy working for.
Right.
That's a very bad idea.
Right. Got it.
It's important for whether you are a small investor, whether you're a family office, to actually bring some discipline in your investing.
Sure.
Only then you can hope to get somewhere. Otherwise, if you let everybody else who's coming to you with tips and recommendations take charge of your portfolio, chances are that sooner or later you will have a rough time.
Right. Which is what has happened now. There has been an information explosion, and everybody on social media wants to dispense a tip or tell you what to do exactly. So I think that's a great advice, especially in these times. Great. Thanks a lot, Ashutosh, for joining us today and sharing all those insights. Thank you, listeners, for joining us today. If you liked this episode and would like to hear 2 more such interesting conversations, do log into our channel, Why Not Mint Money, on Spotify as well as other platforms, where you will find me omnipresent. Also, if you have any new ideas or suggestions, you can DM me on Twitter. My Twitter handle is @Jash Kriplani, that is JASHKRIPLANI, or y'all can always mail to us at mintmoney@livemint.com.
To stay updated on this podcast, follow us at HT Smartcast on all the major social media platforms. To listen to more such podcasts, log on to www.htsmartcast.com.